Business protection planning is designed to protect your company from financial loss in the event of illness or death of the business owners or key employees. You may already have insurance that protects your company against catastrophic events, but have you considered the impact of losing your most important business asset, you or your key employees? With the right business protection arrangements in place, you are more likely to keep your company running, and this video explains the options available to you. Research by Scottish Widows reveals that 77% of organisations say there is at least one employee whose loss through death, critical illness or long-term incapacity would seriously impact the profitability or even the survival of the business. Director loans can become repayable immediately upon death, which means that creditors could become nervous about their repayments being met and seek to change payment terms to protect their interests. Key person protection is designed to ensure against the loss of people within your company who are regarded as key to its success because they have specialist knowledge, skills, or contacts. The cover can be used to help counteract a significant fall in profits or the inability to repay loans. Key person policies can pay out in the event of death, the diagnosis of a critical illness, or absence from work due to accident or injury. Your business can receive a lump sum payment or a series of payments according to your needs. The death of a shareholder can be extremely damaging to any business. Shareholder protection helps remaining shareholders maintain continuity, stability, and control of the business, whatever the eventuality. The outcome of this type of protection puts the right money in the right hands at the right time. It can be a complex area and one that can create much debate amongst the shareholders, but like any difficult conversation, it is better to deal with it sooner rather than later. The key is the quality of the agreements put in place, which help to decide what happens after death to the transfer of the shares. The wrong type of agreement can result in some parties not having their rights protected or attractive tax breaks being lost. The cover works by providing funds that enable the purchase of some or all of the shares from the shareholder or their estate. There are three main ways to set up this type of protection, depending on the policyholder's requirements and the status of the business: life of another, own life in trust, and corporate buyback. The key is using the right one for your business. Once you have shareholder protection in place, you should regularly review the policy to make sure it continues to provide the right level of cover and adequately protects the interests of all parties. To get the right protection and agreements in place for your business, you should consult with a qualified and experienced advisor who specializes in this type of insurance. An experienced advisor can help facilitate some of the more difficult conversations about the change in share ownership that may result from a death of a shareholder in the business. There is no doubt that conversations of this nature can be difficult, but doing nothing is not the solution. It's far better to put plans in place now whilst your business is stable and the shareholders are fit and well. The death or critical illness of a shareholder or key person with no plan in place and only vague discussions on what should happen will create untold stress on all parties. It could even lead to the failure of your business, and it might also contribute to the loss of valuable business property relief on the transfer of shares. If you don't have the right arrangements in place, we can help.